Again, my name is Sid Haas with LKCS. I'm the Vice President of Business Development here. And today's presentation is going to focus on our credit alerting and prospecting solutions and how we help our clients leverage credit union data to improve member acquisition, member retention, and the overall value of that member over the life of their membership. For those of you that are not familiar with LKCS, we've been working with credit unions for over 50 years. We provide a wide variety of solutions, across many different levels and platforms and media. But we focus on really utilizing technology to help our customers improve their marketing and member communications efforts. And today's presentation on the credit alerting and prospecting solutions really cover several of these areas, because we'll show you how we can use that data, obviously to segment and target members, but we'll also talk about how we can incorporate that into campaigns and one-to-one marketing solutions and, go on from there. So when we talk about using credit bureau data, we are purchasing data on our clients' behalf from all three of the credit bureaus. And that's an important distinction, because LKCS is one of the few vendors that you could work with that actually has relationships with all three of the bureaus. So we can pull data from all three or any of the three at any time for you. The advantage there is certainly that the bureaus, they certainly share information. But it's surprising that not all the time the bureaus don't have the same information on every individual. And when we talk about our credit alerting solution in particular, it's important for us to get the most up-to-date information as fast as we possibly can get it. And even though the credit bureaus share information with each other, they don't necessarily share it as quickly as we would want at all times. So our ability to access data from all three of the bureaus is very, very important in some of the solutions we're going to talk about today. And at the end of the day, what that means to you is that you can see a 70% increase in leads when we're pulling data from all three bureaus, as opposed to just working with just one of the bureaus directly. And the important thing to note as well is that there is no additional cost to work with LKCS obtaining data from all three of the bureaus than there would be from accessing data from any one of the bureaus. Since we're discussing where this data comes from, I also wanted to point out the fact that we don't only rely on the credit bureau data itself. We actually supplement that data with multiple data sources that we combine in a very large data warehouse, and then we use all of this information, at our disposal to help target, members and non-members for certain types of loan campaigns. But we incorporate basic demographic information. We incorporate information from the county assessor's offices about all homeowners, nationwide. We have some very sophisticated AVM models that we use to, approximate home values and things like that. All of that information gets combined with that tri-bureau credit data, to really help us both get a picture of your members and also identify those, that would be prime candidates for a loan campaign. What we're going to be talking about today are two different solutions utilizing this credit data. They're similar because they both use data directly from the credit bureaus, but they're also different. We're going to talk about credit prospecting. When we're talking about credit prospecting, we're talking about using credit data proactively. We're going to reach out to members and non-members and, to offer them loans and pre-screen them and pre-approve them for loans that they may not necessarily already be in the market for, but they seem like prime candidates for that type of loan. And we'll talk about this in much more detail. Credit alerting, on the other hand, is using this credit data more reactively. And a lot of people think that's a negative connotation. I do not. It's a very important distinction between credit alerting and credit prospecting. With credit alerting, we're reacting to the fact that we've identified specific members or non-members that are actively in the market for a loan. And once we know that they're actively in the market for a loan, we're going to, obviously reach out to them immediately with a loan offer from your credit union to capture any business that potentially you could be losing to a competitor. And we'll talk about, again, both of these certainly in more detail. When we use credit data, there are stipulations on how we can use that data. The first thing is that obviously anytime we're going to access credit bureau data, we're going to follow your lending guidelines. So you can tell us for specific loan products or specific categories of loans such as home loans or auto loans, you can tell us exactly what your credit requirements are so that we can find, members and non-members that meet those criteria. So you can identify minimum and maximum credit scores. In the case of home loans, you can specify loan to value. Obviously we can look at credit history and make sure there's no repossessions on an auto, no bankruptcies anywhere in the history. We can look at, the number of 30-day, 60, and 90-day late payments, and all sorts of other criteria. Just about any field of data that's available on a credit report is also available to use, in these marketing campaigns. But when you purchase data, or we purchase data for you from the credit bureaus, you are required to use that data by actually extending what's known as a firm offer of credit. And this means that you're in compliance with the Fair Credit Reporting Act. When we access credit data, we have to explain, to people receiving your promotions that we've pulled their name, as basically through the credit bureaus in a pre-screen type offer. And we help with all of that. And for any of you, and I know that some of you, about half it looks like, runs some pre-screen marketing campaigns a few times a year, and half of you don't. But for those of you that do, are familiar with working with the credit bureaus, it can be a daunting task, and it's important to know that we do all of that work for you. We have direct contact, with compliance at the major credit bureaus, so that we can come back and, we can explain exactly what needs to change, on a mail piece or a phone script or an email. And when we come back and explain, that to you, it's not going to be with a 90-page document on the Fair Credit Reporting Act. We're going to tell you specifically what word needs to change, or what sentence needs to be added, or what disclosure item, for instance, needs to be included. But when we make this firm offer of credit, what that means is that you're going to be using language that identifies that the member or non-member is either pre-selected, pre-screened, pre-approved. There's a number of different words that you're using, but you're basically, letting them know that they've been selected, or identified, as being eligible for a specific loan offer. And you're going to include, what product they've been approved for or pre-screened for, what product you're offering, what the minimum amount of credit is that you'll, be willing to extend to them based on, their credit criteria, and even what the rate might be, or a range of rates, or the minimum, rate, as low as rate, for example, that they're going to qualify for. All of that is based on the criteria that that we work with you to identify. And obviously you're going to have all of your terms and conditions and eligibility requirements on any of these mail pieces or emails. So you'll explain exactly what made, not exactly, but you'll explain that these members were obviously eligible for the loan offer that you're extending to them, but you'll also explain why they may not actually be eligible for that credit after all. If they don't have the income sufficient to repay the loan, for instance, if they don't have the collateral that you require, if their credit score changed, if anything changed in their relationship, if they're not, a member in good standing with the credit union, if they're not eligible for membership for some, odd reason, any of those types of things could disqualify somebody from being eligible for an offer, even though you've told them that they've been pre-selected for a specific loan offer. So just because you're telling a member or prospective member that they've been pre-selected, pre-screened, or pre-approved for a loan, that does not obligate you in any way to obviously disperse any funds until they complete your entire application process, and obviously meet all of your lending requirements and lending guidelines all along that process. If there's any specific questions, I don't see any popping into the to the toolbar here. But if you have any questions about using the data and extending firm offers of credit, I'm happy to discuss that in more detail here, or we can, you can certainly contact me offline. The other important piece of information, and I'll show you samples of this in a few minutes, that gets included on any firm offer of credit is there's 2 disclosures that the credit bureaus require us to include, and that explains to the recipient of your offer both why they were eligible for that offer, basically that data was accessed from the credit bureaus, to qualify for them, for that offer, and they also explain how members or non-members, any recipients of your marketing, can opt out of receiving these types of pre-selected campaigns from any lender. So with all of, I guess, the requirements out of the way, we're going to go ahead and jump into credit alerting itself. And we're going to talk about how we can use credit alerting to retain members and cross-sell members, on specific loan products. So one of the things that LKCS has done for several years is, we help our credit unions with traditional loyalty programs. You have a new member, we help you onboard them. We use different types of matrix marketing campaigns and loan recapture campaigns, to cross-sell products and services, throughout the year for many of our clients. Most of these campaigns are not based on actual credit data. So we use demographic information, we use some behavioral models, and we're kind of guessing, at who might be, more apt, to want a specific financial product or service than the next person. What we can't do with demographic information and behavioral models and things is actually predict the exact timing, that a member or non-member is going to be in the market for a specific product. When we layer on the credit data and turn these types of loyalty programs and onboarding programs and things into credit-based programs, what we gain is that ability to react with the right offer at exactly the right time. We are going to be able to identify your members and even your non-members who, are actively in the market for a loan and could be defecting to your competition. It's all based, obviously, on credit bureau data. And again, like we discussed before, and I'll repeat this several times throughout the presentation, we will have that ability to deliver that firm offer of credit to cross-sell a loan. In this case, at the moment that we identify that a member is in that market for a loan or a non-member is in the market for a loan. So here's how credit-based alerting and credit alerting works. Your member applies for credit anywhere in the country. They apply at a bank, at another credit union, at a car dealer, at a mortgage lender. They, apply for a credit card, whatever it might be. Those inquiries, those applications, are obviously sent through one or more of the credit bureaus, and they're categorized based on the type of financial product that member is seeking. Whether it's a mortgage, an auto loan, an installment loan, a credit card, or even certain types of insurance. The credit bureaus receive those inquiries, they process those inquiries, and they categorize those inquiries. Where LKCS comes in is we take your member list, the names and addresses of your members, and we cross-reference that every day or every week with those inquiries that we receive from the credit bureaus. And when there's a match, if the name and address of one of your members matches the name and address of somebody that's applied for a loan, through any one of those bureaus, a lead is generated. And from that lead, we and you both can respond with a firm offer of credit immediately as soon as we identify that lead. You have the ability to select which categories of loans you want to target. So you can, obviously look at home loans, credit cards, auto loans. Maybe you don't offer a credit card. Maybe your auto loan portfolio is saturated and you're not necessarily looking for auto loans right now. You can determine which of those categories of loans you wish to target. Pricing does not matter. It doesn't change based on whether you want to only receive 2 or 3 or 4 categories of loans. So you just decide which types of loans, and leads you want us to identify for you, and we'll identify those. Each of those leads is, again, pre-screened using your credit criteria, and you can specify credit criteria for each category of loan. So you can have different categories, criteria for auto loans than you do for home loans than you do for credit cards. And we can even split within a category. So you could tell us, we want to extend an offer for this type of loan. If when a member is applying for a home loan, they have this credit score. But if they have a higher credit score or a lower credit score, we prefer that you send this offer. So we can change those offers, change the language of the mail pieces, the emails, whatever we're using to extend these offers based on those credit criteria. We receive data every day from Equifax and TransUnion. Every day, in the middle of the night, Equifax and TransUnion transmits their list, of everybody that's applied with them for credit that day. Experian at this point is only providing that list once a week, but we keep hearing rumors that that's going to be changing. But at this point, we can compare your member list with the daily feeds from Equifax and TransUnion and with a weekly data feed from Experian. Once we identify those leads, we can actually fulfill direct mail or emails for you on the same day we have identified that lead, and we will also send you the lists of those leads along with all the associated credit data that you need, on those members so that you can reach out to those members via phone. Again, we work with all three bureaus, and for credit alerting, that's a very important piece of this, because obviously just because you work with one bureau doesn't mean your members are going to apply with an institution or a car dealer or whoever it might be that works with the same bureau. And because of the lag time of the bureaus sharing information with each other, again, you can see in this slide a 72% lift by comparing your membership list with all three bureaus than you might with only comparing it and working directly with one bureau alone. We can do the same type of thing with credit alerting for non-members, only instead of comparing your membership list with that list of the daily and weekly feeds from the credit bureaus, we're going to basically just select a geographical area, and add geographic and demographic criteria that says, I only want to know if somebody that lives within 10 miles of my branches or 5 miles of my branches or in these specific counties. Maybe it matches your field of membership. Maybe it matches a smaller, portion of your field of membership. But we want to know anybody that's meeting these geographic and demographic criteria that apply for a loan. And we want to be able to offer them, a pre-approved loan with our credit union based on their credit score. So we don't necessarily have to start with a membership list. We can do this at the community level. It is more expensive to actually monitor, for credit alerts for non-members than it is to monitor your members for credit activity. So I'll leave you with that, I guess, caveat. But it is possible for us to do that. If you're opening a new branch in a new community, it may make a lot of sense for you to do some, credit alerting for non-members. And those are, specific situations that we'd be happy to talk with you about in more detail. I'm going to switch gears from credit alerting to credit prospecting, and we're going to talk about how we can utilize credit prospecting both for member acquisition and also for cross-selling. So if you remember, credit prospecting is we're going to be a little bit more proactive, and we're going to reach out to members and non-members, and offer them loans, whether they're in the market for a loan or not. And we're just going to tell them, that they've been pre-approved or pre-selected or pre-screened for a specific type of loan, and then obviously promote the benefits, of that loan product that you have and of doing business with your credit union. You can use these pre-screen campaigns for any type of loan product, obviously, with just a few of them being listed on that slide. Again, it's the same concept. We're going to be extending pre-approved offers of credit to members and non-members based on their actual credit information. It's all going to be based on your credit criteria for that particular product that we're offering. And we can offer, we can send direct mail loan, direct mail offers. We can send email offers. For those of you that actually have us mail your statements, we can incorporate, and I'll show you examples of how we can incorporate these pre-screen marketing campaigns directly with your statements. And you will certainly have the ability to make outbound phone calls, both to members and non-members, that are pre-approved or pre-screened for these loans. And also for those of you that use DataFlex, which is LKCS's database marketing platform, I'll show you a couple of screenshots of that in a few minutes. But if you use that, for reporting, you'll be able to use DataFlex to measure the results of these campaigns as well, both for credit alerting and for credit prospecting. So you'll know not only how many offers were sent out, whether they were sent out via direct mail or email or through statements or however it might be, but you'll be able to measure specifically how many of those members or non-members responded to those offers and opened up those loans. I'm going to show you a few potential credit prospecting campaigns just to give you an idea of the flexibility. Again, we have access to hundreds of credit bureau data fields. So based on the product or service that you want to promote, we can help you identify the right combination of criteria, to reach a good percentage or a good portion, of your members or non-members, to be able to leverage that credit data effectively. But I'm going to show you a few examples. These are just examples. They may not be, appropriate to your specific financial institution, but I think they'll give you an idea of what's possible with credit prospecting campaigns. And just keep in mind that you can adjust, these ideas as you need to. Adjust the credit parameters to meet your needs. Maybe you don't do offer a specific type of loan that we're going to mention. Just keep in mind that we can do this for any type of product. More and more of our customers are coming to us and saying, you know what, the auto lending is hot right now. Rates are really low. We haven't really done this a lot before, but we want to go after auto refis and auto recapture business and things like that. So how can you help us with that? Well, there's two campaigns that I would recommend, to customers in this situation, and these campaigns can run at the exact same time because you're actually reaching different populations of members. And that's something you're going to hear from me a few times during this presentation now, because I'm a big fan of marketing automation. And I'm a big fan of putting procedures in place and putting campaigns in place that you can run month after month, quarter after quarter, and they just kind of live on their own, and you're constantly reaching different groups of members, with the same type of offer. So the first piece that I would look at for an auto campaign like this are for members or non-members that have leases coming due. They're currently leasing their vehicle. They've got 1 to 3 months left on their lease. They meet your credit criteria. They don't have any, they've got a good credit score. They have, a nice credit history, all of those things. And we know that in the next 1 to 3 months when that lease comes due, they're going to be in the market for a vehicle. If they're driving something now, chances are they're going to want to be driving something in the next 3 months also. So they're going to either lease another vehicle, they're going to purchase another vehicle, or they're going to buy the vehicle that they're currently leasing. What you can do is offer a pre-screen offer of credit to let these members know that they're already approved, for a credit union auto loan of at least, say, $15,000 at a rate of, 3% APR, whatever the rate might be. And here's why we think you should consider buying your next vehicle as opposed to leasing. It's a very, very limited population of members. In most cases, you're not going to get a very high quantity of members that meet these criteria, but it's a very, very highly accurate target, for you to hit. And, these members, they're going to be doing something, for a loan. We have customers that are running these types of campaigns, and literally they're reaching 10 or 20 members a month, but they can close a very high percentage of those loans. On the traditional auto refi side, we can obviously look at loan payoffs, and we can look at members or non-members that have, at least 2 or 3 years left on their mortgage loan. We can actually, calculate what their payment might currently be, based on what their rate is and things like that. And we can identify those members that you can save, say, at least $50 a month or $25 a month on that monthly payment. So now I can pre-screen, a member for an auto loan, and right on that mail piece or within that email, I can show them over the course of the loan exactly how much money they can save, just by refinancing that auto loan and, bringing that auto loan to the credit union as opposed to keeping it where it's at. So all of that is done for you. You can just tell us, here's the target. We want to identify those people that we can save at least X amount per month. And from there, here's the rate and the term that we're willing to offer people that have this credit score range, and from there we can identify those people. We'll switch gears for a few minutes to talk about mortgages and home loans and stay on the refi side potentially. But, a number of our credit unions now are launching very successful, and have been for the last few months, launching very successful HARP refinance campaigns. So under HARP, what we have the ability to do is actually identify, again, your members or non-members that currently have Fannie and Freddie Mac mortgages, or mortgages owned by Fannie and Freddie, but they're current on those loans. They're not behind on any of the payments, anything like that. And obviously with the HARP program, you can now have higher LTVs and be able to refinance those loans to much lower rates than they currently are. And we have that ability to identify, both who has that Fannie or Freddie mortgage and whether a member is current, on that mortgage and doesn't have any, any delinquency at all and meets your credit score. We actually have some of our clients who originally, originated mortgage loans several years ago, sold them to Fannie and Freddie, and now have come back to those same members to originate another mortgage, refinance the same mortgage they originated the first time to sell it back, and it's providing huge income streams, as you can imagine for them. If you do any type of FHA lending, we have a number of customers that are doing FHA streamlines now. The FHA streamline program is a way for you to refinance a mortgage, an FHA mortgage with a lot less paperwork than was required in the past. So again, we can identify those members that are eligible for an FHA streamline, that have an FHA loan, again, that don't have any lates and things like that, for you to pre-qualify, members for an FHA streamline. At the same time, you might want to look at members that have a very low LTV. They've been in their house for a while. They haven't refinanced that mortgage in recent years. And maybe it's time, maybe you can convince them to actually refinance their mortgage loan with a home equity loan in the first position. They can do that by, and the advantage to the member is obviously that they're saving on closing costs and things like that. And for you, it's obviously, less paperwork again, and less work involved in closing a home equity that might be involved in closing a conventional first mortgage. And again, we can identify, those members that have very low LTVs, and meet your credit criteria to do that. Obviously, there's still a lot of, potential for conventional mortgage refis, all sorts of things like that. Mortgage rates are obviously still at historic lows, so we can identify those people that haven't, refinanced or opened up a home equity loan in the last 3 years. We can even identify when their last inquiry was, so we can make sure that they haven't even tried, for any type of mortgage refinance, things like that. They meet those credit scores that you have. They meet the LTVs that you require, and we can set out those conventional mortgage refinance offers. Let me show you what a few campaigns can look like, as well. So I'm going to show you actually 3 offers. And again, these 3 offers, as we review them, these can run simultaneously because they're reaching different groups, of prospective borrowers. So the first example is a first-time home buyers offer. We can identify which of your members or non-members are renting currently. We can explain to them why they should consider buying now that rates are so low, all those things, and make sure obviously that before we extend, an offer to any of these renters that they meet, that they have sufficient FICO score and meet other credit parameters that would make them eligible for that offer. At the same time, if you're not renting and you own your home, maybe you have sufficient equity in your home. You've got equity over a certain amount, but you also, have kind of abused your credit cards and you're carrying a high amount of revolving credit card debt. Well, if you have, the FICO score that you need and you have the debt to income ratios that are required and all the other credit parameters that could, go along with that, LTV and things like that, for an equity promotion, maybe we can pre-screen some of your members for a home equity loan and explain to them how that can help their budget situation, and reduce that credit card debt. Use that equity in the home to pay off the credit card debt, and how quickly, that can improve their credit, and obviously how much that can save them on their monthly budget. And the third offer is just a general home equity offer. So you may have other members that have that same amount of equity in their home, but they don't have that credit card debt. Well, we're not going to ignore those members. We're just going to send them an offer for the same type of home equity loan, but we're not going to discuss, obviously, paying off the debt with it. We're going to discuss other opportunities to use those funds, for anything that a home equity can pay for, which obviously is anything. So, it's just going to be the same offer, and the end result to you is the same type of home equity loan, but the language to that member is going to be much more relevant to their situation than it would be if you just sent them, something about a debt consolidation type offer when they don't have that high amount of credit card debt. These types of campaigns can be sent as fold-over postcards, such as the one shown here. Typically, the disclosures and the opt-out notices, like this box right here is an example of the opt-out notice that's required on every one of these offers to be in compliance with the Fair Credit Reporting Act. Typically, those are too large to put on a traditional postcard. So, this would be something that folds in half. But this is an example of that first-time home buyers, offer that I had just mentioned. These can be personalized letters. So the example on the left, and this is probably the most, popular way of extending these pre-screen offers, but the example on the left is that revolving debt reduction offer. So it may be hard to read on your screen, but it says, the current economy will be straining your budget. We can make it easier for you to pay off your credit card bills, cover tuition expenses, and consolidate other debt, without having to work overtime or dig into your savings for monthly expenses. And it goes on to explain that the member's pre-qualified for a home equity loan. The piece on the right is that standard home equity offer. So you're not going to see the language, about that credit card debt or anything like that, but they're going to be approved for, basically the same loan, as that debt reduction offer. You'll notice at the top in these examples, these are actual examples. I shouldn't say actual examples, but these are examples of what the first page of your monthly or quarterly statement could look like. So I mentioned before that we actually are doing this with statements for some of our customers. We have the ability to take the first page of a member's statement and convert it into a targeted direct mail campaign. So in this specific example, we're taking, we're pre-screening, say, all of your quarterly statement members. We're identifying which of those would be eligible for these loan offers. And for those members that meet those credit criteria, we can then extend these offers and include these offers with the statements. These same types of offers can be sent via email. So these are examples of what these offers could look like via email. The credit bureaus are 100% fine with you extending firm offers of credit via email. Now, obviously, with email, you're probably only going to be able to reach members that you have email addresses for. You wouldn't necessarily be able to extend an email offer to non-members because you wouldn't have them. But we can, obviously send a portion, of these offers out via email for members that you have email addresses for, and send the rest via direct mail. So there's, obviously the opportunity to combine that. I didn't show examples, but I can be happy to send you samples of phone scripts as well, to show you the types of language that you would need to use, when you're talking to a member, over the phone about a loan offer that they're eligible for. I mentioned DataFlex before. LKCS does have a database marketing tool called DataFlex. It's similar to some of the MCIF solutions out there. We feel it's much easier to use, but we do incorporate all of this credit data into DataFlex, which allows you to track the results of individual credit-based campaigns. So we'll be able to show you not only the credit score breakdown and things of your members, but also by credit score range and things, how many of these recipients of these pre-screen campaigns have opened up the loans, what the balance of the loans are, and obviously use all that information to help you calculate, the ROI on these types of campaigns. So I'm sure you're all wondering what this costs, so I want to give you some of that information. Credit prospecting, which is what we were just talking about, those types of auto loans and home loan campaigns, the examples that we went through, that pricing is based on the number of records that you purchase. So when we pre-screen either your members or non-members, this is entirely based on the number of records that you purchase, the number of people that meet those credit criteria that we're going to send these offers to. Prices can vary a little bit based on the demographics you select, but typically you could expect that the cost is in the neighborhood of 25 cents per record. You'll see it vary a little bit, but 25 to 28 cents is a very good budget figure that you could use on credit prospecting data. For those of you, about half, like I said, that are used to working with the credit bureaus and purchase data from them on a regular basis, what you'll find is that the credit bureaus do have minimum charges. And I would imagine that for most of you purchasing data from the bureaus directly, that your minimums are probably in the neighborhood of $2,000 or $2,500 per campaign. Well, we do have minimums as well. Look, the credit bureaus require us to have minimum charges, but because of the volume of information that we're purchasing, we've actually negotiated very low minimums with the bureaus. And one of the key distinctions is that our minimum charge is a monthly minimum charge, not a campaign minimum charge. LKCS has a $750 monthly minimum charge on credit data, and what that means is that any month that you purchase credit data, you certainly don't have to purchase credit data every month, but any month that you do purchase credit data, you have to commit to purchasing $750 worth of data. However, you can have multiple smaller campaigns that you're purchasing data for within that same calendar month, and you can basically add all of those together to satisfy that minimum. So for the examples that we discussed, like the credit lease, the auto lease coming due example, chances are you're only going to have a very small number of members that meet that. You're not going to have to spend $750 for that data alone. You're going to combine that with other campaigns, whether they're auto campaigns, mortgage campaigns, credit card campaigns. You're going to combine those together to satisfy that minimum. We can run counts and cost estimates for you at absolutely no charge anytime. So if you're just thinking, of, boy, it would kind of be interesting to see, how many of our members meet these criteria for this loan campaign, or I wonder, how many people live within 5 miles of the branch that would be eligible for this HARP campaign that we talked about, for example. Give me a call or send me an email with the criteria that you're looking for, and I can very easily, query the credit data and get you a cost estimate and a list count back. And we can do that very, very quickly. Again, for those of you that have ever worked with the bureaus directly, when you ask for a list count from the bureaus, it can be a week, 2 weeks, or a month before you hear back from them. We have access to their data, and we can actually pull those counts within a few hours, typically, of receiving an inquiry from you. So, like I said, if you're just thinking about doing this, or if you have an upcoming campaign, similar to one that you've run in the past, and you just want to see how we compare, just let me know what that is, and I'd be happy to do that for you. On credit alerting, where we're actually, again, monitoring, your members for credit activity every day, that cost is based on the number of members that we're screening each month. And what we do there, and I'll show you some examples, but what we do there, as far as to give you an idea of an accurate cost estimate, is we recommend running what we call an opportunity analysis. And if you can, LKCS is SOC 2 certified, which is replacing the SAS 70 certification. We'd be happy to provide, obviously non-disclosure agreements and all the reports that we need to get secure data from you. But we can take your member address list, just names and addresses of your members, and we can upload that to the credit bureaus, and we can identify exactly how many of your members applied for auto loans, mortgage loans, and credit cards in the past 30 days, and how many of those members would meet your pre-screen criteria for loan offers. And once we have those hard numbers, we can then help you do some analysis to determine what the ROI is on a credit alerting campaign. To give you an idea, I want to share some numbers with you so that you have some idea of what credit alerting can cost. The example that you're seeing on your screen is actually based on closing some mortgage loans. So we're doing credit alerting. We're identifying members that are in the market for home loans, and we're going to assume that every loan that we close has an average loan size, a mortgage loan size of $150,000. Now, on a mortgage loan, we're also going to assume that the total revenue of that loan is between 2.5 and 3% over the life of that loan. Well, if we're monitoring, for example, on the first line here, 15,000 of your members, what we find is that about 1% of members are both in the market and meet your credit criteria every month. And again, these numbers on this sheet are very conservative, but we think it's a very good place for you to start to determine if credit alerting makes sense or not. So based on that 1% figure, about 150 members will be in the market for a loan and meet your credit criteria every month, meaning that we're going to contact these 150 members with a loan offer. If that loan offer is only made via phone, if this is something that your loan officers are, we're going to deliver those leads to you every day, you're going to hand them off to your loan officers, and they're going to call these members, we're going to assume that they're only going to reach about 30% of those members. You're going to be calling members at home when they're at work. You're going to be calling numbers that are no good anymore. People are going to want you to call their cell phones instead of their home phones, whatever it might be. We're going to assume in this example that you can only reach 30% of the people that you're going to call. But when your loan officer gets one of these members on the phone, one of this 30%, you're going to know that these members obviously have a relationship with your credit union, that they're actively in the market for a loan, and that they meet your credit criteria for that loan. So it should be fairly easy for you to close 10% of those loans. Again, we see numbers that are significantly higher from some of our customers, but to give you a very conservative estimate, what this all means is that you'll be able to generate 5 new loans a month. Because when you start with when you start with 15,000 members that we're monitoring, 150 of those members are in the market each month. You're going to contact 30% of those, so you're going to reach about 50 of these members, and you're going to close 10% of those loans. You're going to close 5 loans. Based on that average loan size of $150,000 and the revenue of 2.75%, that's going to bring in revenue of $20,625. The list cost for credit alerting for monitoring 15,000 members is $1,400 per month. So what that means is that you've generated $15 in revenue for each marketing dollar that you've spent. This is going to vary for each of our credit unions. To really get an accurate picture of it, I encourage you to take me up on my offer to run that opportunity analysis, because that'll give you some, some hard numbers. I also want to show you one other tool that you can take advantage of, and we'll actually put this to work in a second, but LKCS does have a credit alerting calculator on our website. you can find it at this address on the top, and this is lkcs.co, not .com, lkcs.co/calc-ROI. We've shortened the URL because it's kind of a really long link. But I'm going to actually click on this to show you how this calculator works. And this will enable you to put in numbers that are specific, to your credit union, so that you can see exactly, what the potential return on credit alerting would be. So let's say I'm starting and I want to monitor 30,000 members. And I'm going to leave the default contact rate at 35% just to see. And maybe I'm not interested in installment loans, so I only want to look at mortgage loans and auto loans and credit cards. And I know from talking to my loan officers that when they're talking to qualified members, they can close 10% of mortgage loans. Maybe they can close 10% of auto loans. And, maybe we don't do so well on credit cards. We only close 6% of those. And I also know from talking to my loan staff, that this is the average revenue that I make on each mortgage loan, auto loan, and credit card. I can change any of these numbers. Maybe when I do get a credit card, I do a little bit better. Maybe I do $350, in revenue on average on a credit card, for instance. And we're also going to include the cost of printing and mailing and any email marketing and any outbound phone calls. I'm going to assume in this example that it's going to cost me $1, to send out a letter and send out an email and make a phone call. Again, you can, adjust these numbers however you need to. And I'm going to just calculate for this, mock credit union what the return on investment would be for credit alerting. So again, you can see what the, how many loans we anticipate generating for a credit union that's 30,000 members meeting these conditions. You can see what the data monitoring cost is, what that marketing fulfillment cost is, so what your total costs are on the campaign, the revenue generated, the cost per loan, and the revenue per dollar spent. So just to give you an idea, play with this calculator. Again, you can find it on our website, and I'll send you the link via email this afternoon as well. And beyond that, again, I encourage you to take me up on my offer for that opportunity analysis, because with that, we can show you exactly how many of your members were in the market for a loan in the past 30 days. And you'll be able to estimate from that how many of those loans you could have potentially closed. That is all I have for you today. Like I said, I will stay on the phone, and be happy to answer any questions that I see coming up. But please just type any questions that you have into that GoToWebinar toolbar on your screen. Thank you again for participating today. Please feel free to contact me anytime after the presentation, and I'd be happy to discuss your unique situation with you and determine if either credit prospecting or credit alerting makes sense for your credit union. Thank you very much.